It's Europe's biggest private equity conference, IPEM, getting underway in Cannes. She got the ticket to the south of France. I go to the mountains where it's sub-zero. Danny Berger's on tour. Danny, take it away. Good morning.
Hi, Manus. Good morning. I was going to say a cruel world. You're in the snowy Alps. I'm in the almost sunny south of France. So, Manus, I'm really excited for this conversation. Joining me now is Thomas Friedberger. He is the Deputy CEO of French Private Equity Fund and Private Capital in general, TKO. Thomas, so great to speak with you this morning.
Danny.
So here we are. We're at IPEM. This conference took place not that long ago in September. And at it, your co-founder, Mathieu, said that the industry hadn't yet woken up. They hadn't yet seen reality when it comes to deal valuations. Do you think reality is sunken yet for the industry?
Look, it's starting, and there are reasons for that. I mean, the interest rates in the US, for example, just last year, short-term interest rates have gone up by more than 400 basis points. In Europe, more than 200. So valuations, at least multiples, have to come down. It's starting. It's probably a beginning. But look, I mean, it's a bit windy here in Cannes. It's also a bit windy on the world economy, and it's not the end of the world. It's okay.
I like what you've done there, Thomas. So how bad does it get then? Where are we now, and how much further does it fall in terms of valuations?
I mean, mechanically, the multiples in a rising interest rates environment have to at least go down slightly, and so any kind of increase, it doesn't prevent the industry from showing increases in valuations, but those increases will have to be justified by better businesses, by increases in EBITDA, and there are still sectors that are extremely resilient.
Which are those?
Well, those sectors are mainly focused on mega trends, concentrating the high growth, and those mega trends are the ones helping the all companies in the world building resilience. So, for example, cybersecurity, energy transition, digitalizing the industry 2.0. Those sectors are still experiencing very high growth, and it's probably a long-term trend despite the economic cycle.
So you have to focus on those companies that can deliver growth. But it used to be, just as a quirk of mathematics, cheap financing essentially meant that anything would go up, as long as you could use the cash flow to pay down the debt. So does the fundamentals, does the math of deal-making change if cheap financing is gone?
Look, I mean, when the storm is there, you have to stay strong on your basis. And in our case, it's selecting assets, asset picking, doing your own financial analysis. It's true that those trends of constantly lower interest rates, globalization, helping a lot of optimization, a lot of financial engineering, this time is over. It doesn't mean that there is no value to create. There will be a lot of opportunities, both on the basis of lower valuations in sectors that are suffering a little bit, and on those mega trends still encompassing the most of the growth. So, it will be less easy, but at least, we'll see a lot of dispersion in fund performance, and we hope we will be on the good side.
What does that look like for the industry, that dispersion? I mean, are there more funds closing? Is there more consolidation? What's the outcome of that?
So we think that the asset management industry more globally is consolidating. The distribution modes are changing, are in deep mutation with more access to, I would say, non-institutional investors, which is, we think, a good thing because it's financing the real economy. And then also, probably this cycle will show that the alignment of interest is something which is important. It's something that we do because we are very capitalized at TKO. We have more than 3 billion shareholder equity and a balance sheet of 4.5 billion euros. So we put our money at stake together with our LPs, so that we will be the first one to suffer if we do investment mistakes. And it's probably a trend which is starting, which is, LPs will continue, obviously, to allocate capital, but they will take much more care about the alignment of interest.
Are you seeing that across fundraising? Because we've heard from some of the big funds. I mean, Carlyle, for example, they've had to extend out their fundraising to lengthen the timeline of it to hit their goals. Is this now the norm for 2023?
Look, it's probably, I mean, everything is slowing. The economy is slowing. We are probably entering into a phase of lower growth globally, which will last for decades probably, because there will be less optimization, less efficiency, and more resilience, which means lower growth, but we have to cope with that. And in our case, most of what we do in private equity is impact investing, and on that front, impact investing, the things are not slowing at all. So, hence those mega trends I was talking about.
We mentioned financing and this idea that there's less of it. You, of course, you've spent a long career before TKO in banking, in debt capital markets. How bad would you compare this current period of the difficulty to get leverage financing for deals?
Well, I would say it's a pretty classic, cycle, knowing that the last one was really a banking crisis, so it was not a classic cycle. It was so nothing to compare with 2008, to be precise. But look, I mean, financing levels have increased, so it's less easy to get leverage, and it means that you have to do with that. In our case, we don't use a lot of leverage because what we do is providing patient partnership capital to entrepreneurs. So it's long-term investing using no leverage or very few. So it's not necessarily an issue. But of course, I mean, higher interest rates are slowing the pace of capital return, and it's not necessarily a bad thing, It's,
why do you say that? Why is it not a bad thing?
No, because the speed of return of capital was not normal. I mean, everybody in this industry says we're investor for the long term. But the capital was coming back very quickly. It's not the norm. I mean, the norm is you have to invest long term, you have to be patient, and you have to give the time to your portfolio companies to create the value, not by performing financial engineering, but by performing, by being good at what they do in their business.
Thomas, there's not a lot of people who would say that it's good that things aren't returning as quickly as they were.
Look, I mean, I'm not saying I'm saying it over the long term. That's the only way to be sustainable.
Sure, it's more healthy. I get it, Thomas. Thank you so much for joining. Hopefully the wind stops and you can warm up for the rest of the day. Manus Tom, that's Thomas Friedberger, Deputy CEO at TKO.
You see, Danny, you went long enough there for the dawn to break and the yachts to be seen. Danny Berger living at large in Cannes with the TKO Capital Deputy CEO.